Okay, so we're going to continue our conversation on receivables. Yesterday we were talking about accounts receivables, and we went into detail about accounts receivables and its impact and so on. Today we're going to talk briefly about notes receivables. So notes receivable basically is a written promise to pay. Accounts receivable is not a written promise. It is not a contract. It is an understanding, a mutual understanding between the two parties. Notes receivable, on the other hand, is a written contract, and there's obviously a definite time period to that. So the next slide shows the differences between accounts receivables and notes receivables. Now these are not differences which are given to you by, these are basically opinion-based differences. They're not hard and fast rules, they're just there for you to understand. So usually accounts receivables decrease over time and notes receivables usually increase over time. What happens is you convert AR to NR, but you do not convert NR to AR. So the way it works is, let's say you have $5,000 of AR from a customer. After 90 days, the customer says, I need a bit more time to pay. So what you do is you then convert that AR into NR, into a notes receivable. You actually make it a written contract, and you say, okay, we'll give you an extra 90 days or an extra 6 months to pay, but this will be a definite contract and these will be the terms of the contract. There's usually interest attached to notes receivable, and there's usually no interest attached to accounts receivable. For an accounts receivable, as I mentioned, there's usually just an invoice, a mutual understanding. A notes receivable usually has a contract. Accounts receivables are usually due within 60 or 90 days at the max, and notes receivables start after accounts receivables have been overdue for that time period. So what are some of the journal entries with regards to notes receivables? So what happens is, when you receive, you can have the opposite of notes receivable is note payable. So if you have a note receivable, the other party has a note payable, just like accounts receivable and account payable. So when you receive cash and promise to pay a note, it will be debit cash, credit note payable. And when someone writes a note to you that they will pay you later, then it's obviously debit note receivable, credit cash, not AR, but usually credit cash. And when you pay the note, it will be debit note payable, credit interest expense, my fault. Debit note payable, debit interest expense, credit cash, because you would have an interest expense attached to the note payable when you are paying. When you receive the notes receivable from someone else, you would have interest revenue attached to it. So it would be debit cash, credit notes receivable, and credit interest revenue. So here we come to a third type of receivable, which is interest receivable. So you might even have notes receivable and interest receivable based on the interest amount that you are supposed to receive from the note. How do you recognize notes receivable? Again, this is where an accounts receivable is being converted to a notes receivable. So you would have a debit notes receivable, credit accounts receivable, if that is the case where accounts receivable is being converted to a note receivable. So this is how you recognize the note receivable, and you would obviously value it at that at the value that you've converted it. So some of the similarities, for example, accounts receivable and notes receivables, usually both are current assets, but yes, I understand under IFRS there is no real difference between current and long term. However, it's still prevalent in the terminology, and it's also prevalent in understanding of balance sheets. They both would have a net realizable value attached to it, because there may be some allowance for doubtful accounts for accounts receivables, and there can also be allowance for doubtful accounts for notes receivable. So for short, I would call that ADA for accounts receivables and ADN for notes receivables. And there would be a bad debts expense allocated to ADN if you have that concept, and the process will be similar. So each of the types of receivables, which is accounts receivables, notes receivables, other receivables such as interest receivables, should be identified in the balance sheet or in the notes, and they are also reported obviously on the balance sheet, on the face of the balance sheet, as a receivable. So in the income statement, the accounts that are affected, the account that's affected is the bad debt expense, and then you may have interest expense and interest revenue to deal with if there is the interest concept applied with the notes receivable. In the balance sheet accounts, you have the accounts receivable, the notes receivable, the allowance for doubtful accounts, and allowance for doubtful notes if you're using notes receivables. So in this chapter, basically we've gone through accounts receivables, notes receivables. We've touched very briefly on interest receivables. There may be other types of receivables such as taxes receivables. If you have overpaid taxes, you may be receiving some taxes back from the government. So there's all these types of receivables that may happen or that may occur during the life of the business. So as long as you understand the concept of receivables, you'll be able to go through and understand the concepts of the other types of receivables that you may have to deal with. So in this chapter, in conclusion, we've talked about accounts receivables, allowance for doubtful accounts, notes receivables, allowance for doubtful notes, interest receivables, and all the other types of receivables that you might have, and what kind of journal entries you may be expected to do. So that was it for this chapter. Thank you.